If you borrow $500,000 over 25 years at 5% interest, you don't pay back $500,000. You pay back roughly $876,000. That extra $376,000 goes straight to the bank. Here are 5 ways to keep more of it. Strategy 1. Switch to accelerated biweekly payments. This is the easiest change you can make, and most people never do it. In Canada, interest on your mortgage is calculated semi-annually and charged monthly. When you make monthly payments, you're making 12 payments per year. When you switch to accelerated biweekly payments, you're effectively making 13 monthly payments per year instead of 12. Here's how it works. Take your monthly payment and divide it by 2. Pay that amount every 2 weeks. Because there are 52 weeks in a year, that gives you 26 biweekly payments, which equals 13 monthly payments instead of 12. On a $500,000 mortgage at 5% over 25 years, your monthly payment would be roughly $2,923. Switching to accelerated biweekly payments of $1,461 every 2 weeks would pay off your mortgage roughly 3 years earlier and save you over $34,000 in interest. You barely feel the difference in your cash flow. But over 25 years, you save $34,000 and get 3 years of your life back. Call your lender and ask them to switch you. It takes 1 phone call. Strategy 2. Use your annual prepayment privileges. This is the one most Canadian homeowners completely ignore. Almost every closed mortgage in Canada comes with prepayment privileges written directly into your contract. Most lenders allow you to make annual lump sum payments of 10 to 20% of your original mortgage balance without any penalty. On a $500,000 mortgage with a 15% prepayment privilege, that means you could put up to $75,000 extra toward your principal every single year without triggering a penalty. Most people will never have $75,000 lying around. But even smaller amounts make a massive difference if you time them right. A $20,000 lump sum payment in year 1 of a $500,000 mortgage at 5% could save you over $40,000 in total interest and shorten your mortgage by more than 2 years. The same $20,000 payment made in year 15 saves significantly less because the interest front-loading has already done most of its damage. The earlier you make lump sum payments, the more powerful they are. Tax refund, work bonus, inheritance, side hustle income. Any lump sum you can direct to your mortgage in the early years has an outsized impact. Check your mortgage contract for the exact percentage your lender allows and make the payment early in your anniversary year, not late. A payment in January saves more interest than the same payment in November because you benefit from the reduced principal for more months. Strategy 3. Increase your regular payment amount. Most Canadian lenders allow you to increase your regular mortgage payment by 10 to 20% above the original amount once per year without penalty. This is separate from lump sum privileges. On a monthly payment of $2,923, a 10% increase means paying an extra $292 per month. That's roughly $67 per week. Over the life of the mortgage, that extra $67 per week could save you over $50,000 in interest and pay off your home 4 to 5 years earlier. The reason this works so well is that the increase is permanent. Once you raise your payment, it stays raised for every payment going forward. The compounding effect over years is enormous. And because most people get annual raises at work, the extra amount becomes less noticeable over time as your income grows. Set a reminder on your mortgage anniversary date. Call your lender and increase your payment by whatever your budget allows. Even 5% makes a difference. Strategy 4. Refinance or negotiate a better rate at renewal. This one is boring, but the math is powerful. Over 1.2 million Canadian mortgages are renewing in 2026. Many were locked in at rates around 1.9 to 2.3%. They're renewing at 4 to 5% or higher. If you're approaching renewal, you have options. First option is to negotiate with your current lender. Banks don't want to lose your mortgage to a competitor. Call them 90 to 120 days before your renewal date and tell them you're shopping around. In many cases, they'll offer a better rate than the initial renewal letter. Second option is to actually shop around. Mortgage brokers are free for borrowers in Canada. The bank pays them a commission out of the bank's margin. A good broker can compare rates from 30 or more lenders and find options you'd never see on your own. Even a 0.5% reduction in your rate makes a significant difference. On a $500,000 mortgage, going from 5% to 4.5% saves you roughly $54,000 over the full amortization. If you keep making payments at the old higher amount after refinancing to a lower rate, you'd pay off your mortgage over 3 years faster and save over $100,000 compared to someone who just accepted the original terms. The key is to start the process early. Don't wait for the renewal letter, and don't just sign whatever your current lender sends you. That renewal letter is a starting offer, not a final price. Strategy 5. Invest instead of prepaying. This is the spicy one. Let's say you have an extra $500 per month. You could put it towards your mortgage, or you could invest it. If you use that $500 to make extra mortgage payments on a $500,000 loan at 5%, you'd pay off your mortgage roughly 4 years earlier and save around $68,000 in interest. If instead you invested that $500 per month at an average annual return of 8% over 25 years, you'd have roughly $475,000 in investments, plus a paid-off home. The mortgage payment route gives you roughly $68,000 in interest savings. The investment route gives you roughly $475,000 in portfolio value. Mathematically, investing wins. But there are important caveats for Canada. Capital gains are taxable. The recent changes to Canadian capital gains inclusion rates mean that gains above $250,000 are now taxed at a 66.7% inclusion rate instead of 50%. That takes a real bite out of investment returns. Your mortgage interest in Canada is not tax deductible on your primary residence, unlike the United States. So every dollar of interest you save by prepaying is a guaranteed after-tax return at your mortgage rate. At 5%, your mortgage prepayment gives you a guaranteed 5% return with zero risk. The stock market may average 8 to 10% over long periods, but it's not guaranteed. There will be years where your portfolio drops 20 or 30%. If you lose your job during one of those years and your mortgage payment is still due, that combination can be devastating. The right answer depends on your risk tolerance, your job security, and your time horizon. If you hate debt and want guaranteed progress, prepaying wins. If you have a stable income, a long time horizon, and you don't panic when markets drop, investing probably wins mathematically. Most Canadians who do well financially end up doing a combination. Make the accelerated biweekly payments, use some of your prepayment privileges, and invest the rest.